Hey everyone, it's your bestie Sheila, your favorite realtor. Today we have Ken Byrne with First Heritage Mortgage talking about the 2-1 buy down program. It's been around for a while actually, but hasn't been used because rates have been so great for the past 2 years. But now that the rates have gone up or are actually back to normal, the 2-1 buy down is a great program for buyers to consider when buying their home. So please watch and enjoy. Hello, Kenneth. How are you?
Oh, Sheila, just fine.
Okay. So, now I guess we'll just be talking about your 2-1 buy down that we discussed earlier.
It's not new. They were around back in the 90s when I first got into business.
Oh, really? Yeah, I think I heard that.
Yeah. The thing about it is nobody really did them because rates were low.
Yeah.
And when we did them back then, you qualified at the bought down rate. So people were using them because rates were so high, and then they could qualify at the rate that's lower. And then the theory was your income grows into it. So we were qualifying people better. Now, because of how the finance industry is, we have to qualify everybody at the note rate.
So right now, as of today, what's the rates at for like a conventional?
Probably 7.25-ish.
7.25. Do you foresee it going up further?
I don't know. We've been actually fairly stable for the past couple of weeks. Goes up a little bit, comes down a little bit. This week's been pretty good. Yeah. The thing about it is people keep saying, oh, rates are going to come down, but what are they going to come down from? Are they going to come down from right here? Or are they going to come down from 7.75 and we still have some room to go? I think that's the big thing that the banks are worried about. And that's why we don't see a lot of rates with no points, because the banks know that as soon as rates drop, they're going to get runoff from all those loans that are done. Say you're doing a 7.5% with no point rate and rates drop to 6.75. Every one of those 7.5s is getting refinanced. So the banks are very leery about doing rates with no points. That's why you're seeing everybody charge points, because we just don't have interest rates with no points a lot of times now.
So how many points would someone have to pay to get a rate now?
Well, let's just say 7.25 is zero. And it used to be 1 point was every 0.25% in rate. Now, because the banks are looking at it that they want to hold on to their loans, we've got some investors that are going to give you, if the rate's 7.25, you might be able to get 6.75 with 1 point and 6.5 with 2 points. So they're willing to discount the rate by paying points, because they know, hey, you know what? If I give a 6.5% rate now with 2.5 points, let's just say, yes, that's cheaper than it should be. But if rates drop, I'm not getting my loan refinanced. So then they can budget in and assume they're going to keep that loan for a longer period of time. Whereas a bank that says, well, I'm going to do 7.25, no points, if rates drop to 6.5, it's gone. Whereas the other guy, well, I still have my loan and I made the 2 points up front. So there's a lot of credit unions are doing rates with points, and they're discounting them quite a bit in order to get the customer and then keep the customer. And the buy downs are additional costs on top of points. You can get your rate down one or two ways. You can take a 0-point quote and pay points to get it lower and get a rate that stays wherever it is for however long your loan is. Or you can do the 2-1 buy down and you pay points. They're called buy down subsidy at that point, but you're buying your rate down 2% from the note rate. So if you look at an example of, hey, I can give you 7.25, no points, or 6.5 and 2. But if you do a buy down, I can get you 5.25 if you pay me 2 points. And then next year your rate goes to 6.25, which is still better than the 6.5. And then year 3, you're going to be at 7.25 for the rest of the term of the loan. But the thinking right now is within that 3 years, rates are going to drop enough for you to refi.
Yeah.
So why not? And the hard part is the seller or builder is the only people that can pay it. The buyer can't subsidize it himself.